So get this number. $7 trillion has been announced to be spent in artificial intelligence and data centers between now and 2030. To put that into perspective, the United States military budget per year is around $1 trillion-ish. We are talking about the largest capital deployment announcement that we've ever seen in absolute dollars. So what does that mean, and why would some of these guys even do this? So you're talking about Mark Zuckerberg committing $600 billion. Sergey Brin is back from his yacht, now working in Google or Alphabet 5 days a week. They are offering, in some cases, billion-dollar pay packages to top AI researchers. So let's put ourselves in the perspective of the utopian view of what they're thinking and doing before we try to strawman it and knock it down. So a really thoughtful AI researcher by the name of Julian Schreitzweisser, who's been at OpenAI for 10 years and now is at Anthropic, put out a very interesting chart discussing how the capability of these models is really doubling about every 7 months. So that sounds great. You know, they're getting smarter and smarter. We observe it in our daily use of the models as well. So why is that important? Concurrently, OpenAI published a study with citing benchmark data from an entity called GDP Val, which talks about how good some of these models are in actually completing the tasks of different white-collar jobs and processes across many different metrics. And you're starting to get to the point where many of the models are becoming closer and closer to the capability of a professional in that field. And that is the utopian holy grail, where this next doubling of the capability of these models may push these artificial intelligence models to the point where they're as good, in some cases better than humans in many fields. So you don't need 15 legal associates, you may need 2. You don't need a team of auditors at some of the big 4 accounting firms. You may need a few overseeing some of the audit work happening. And we'll go down the line across many, many jobs. Sam Altman has publicly stated that he thinks that 40% of white-collar workers' jobs can be removed or augmented or helped out by artificial intelligence over the coming couple of years. Not 10 years out, a couple of years out. So the pace of theoretical disruption here, the pace of economic value creation is what they're all going for. Putting that finally in perspective, there's about $50 trillion annually of salary in white-collar work across the world. So if you're going to spend a couple $1 trillion, that's the holy grail. Now,
Sorry, to be clear, you're going to spend a couple of trillion to save some big chunk of that 50 trillion.
Yes.
It's a high ROI.
That would be a high ROI. We're not there yet. There's $40 billion of AI revenue run rate right now. 40 billion. Most of the profit is actually accruing to NVIDIA. Everybody else is losing money. So when we hear announcement upon announcement of trillions of dollars of money going to work, NVIDIA is getting a ton of money from their chips. AMD is going to start getting money for their chips. Blackstone gets money for their data centers. The utilities are getting more money for selling a whole lot more electrons. But we're not yet seeing at all the profit potential from the actually underlying models. And that is what is the, let's call it the big debate of the day as to can any of the large hyperscalers get a return on these hundreds of billions, if not trillions of dollars of capital.
Sorry, is it time for straw man? I just want to throw one thing out.
Yeah.
The other day, and I think many of us are doing this, when I have a question, first off, I haven't done a Google search in probably a year at least. Mm-hmm. And what I do is I'll open up 3 windows and I'll ask 3 of the LLMs the same question, and I'm quickly comparing the answer, and they vary. And as we all know, different LLMs are better at different things, and of course that changes, it seems like every month. But it struck me that the fact that I'm looking at 3, what a commodity these are. Because I will tell you, I'm old enough, believe it or not, that back in 2000, it was 2000, we all used Ask Jeeves, we all used a whole bunch of different search engines, and then somebody finally told me about Google, and they said it's the most honest, least conflicted model, and I only use one. I always used one search engine, but for the LLMs, I'm using 3, sometimes 4, if it's a really big question.
I couldn't agree more. So if we would have had this argument 2 years ago...
Are we arguing?
No, we're not arguing. If we would have asked this question 2 years ago, OpenAI was so far in the lead and no one else was even close. Roll forward to today, you have, let's just count. We have Anthropic, we have Musk's venture with XAI, we have Google with DeepMind, we have OpenAI, we have Perplexity, and then you have about 17 Chinese open source models that, according to the people in Silicon Valley, they would argue they are the best open source models in the world. They are probably 90% as capable as some of the closed models in the US at 90% cheaper price per token or per unit of effectively thought. Those models are actually being used in the United States on US servers. It's not like the data goes back to China. So it is highly competitive. So while this holy grail of productivity and making companies more efficient is likely to move forward on some curve, how the big model producers and providers actually monetize that's harder to see. And especially given how much money they're spending, it's highly concerning. And that's what you're hearing on CNBC in the morning and Bloomberg and all the speculation. And is there an AI bubble? There's credence to the concern that these hundreds of billions of dollars that the richest companies, individuals, governments are spending around the world may not have a return on it at that level. But the S&P 493 may actually see a really nice productivity improvement. They need to hire less people. Their people are more productive. They're more efficient. They're cutting costs. It's net on the margin, that is all deflationary, but it could lead to higher profit margins, which is really good for profitability of stocks, just not the big guys. Let's pause and let's take this down to what it means for actual positioning client portfolios and where we see going. So when we talk to Blackstone, which we do, or when we talk to some of the power guys that we talk to, and we do, it's not like it's a flip decision to decide to build a data center the size of Manhattan in the middle of Texas. You need permitting, you need power, you need construction, you need long-term contracts. This stuff is going forward. When these announcements are getting made, the contracts are being written, signed, dealt with, the communities are being dealt with, you have construction, that is all lining up. So current data center power demand in the United States is about 4.5% of electricity supply. That's expected to double, if not maybe go to 10% by 2030. We're seeing every available electron across the country being used. Not just across the country. If there's free electrons or cheap electrons in the Middle East or in Scandinavia, you're seeing some of the training models being put there. So it's an all of the above strategy as far as producing energy. And that means, in our opinion, more nuclear, more natural gas, more oil, more solar, more wind, and even more coal being consumed where it's available, where there's not as many environmental regulations. We are not passing judgment from an environmental standpoint, but the reality is this is happening and we're seeing it live. This leads to the second part of our, how we're thinking about positioning client portfolios on a go-forward basis. Because if companies are more profitable, and we're using more stuff, and we have exposure there in commodity equities and different commodities and overall corporate profitability on a global basis, that's great. But if labor is weaker, what's the government going to do? We know that very well. They're going to stimulate, right? So that means there's further pressure to lower interest rates. Trump last week already put out that maybe we'll give everybody $2,000 a year as part of the tariff revenue. So the start of transfer payments to people, the start of making sure that workers are taken care of, the start of trying to address a potential weaker unemployment scenario is happening. And that's where we can be in a really odd scenario of lower rates, weak employment, yet high profitability. Postulating here, that's not a normal business cycle.
Wow, what does that mean?
Well, that means, and again, we are observing, this follows the narrative, gold's up 50% this year. Gold's an insurance asset that we've held since we've started managing client portfolios.
I'm very proud. Since 2015,
Yeah.
gold's been a core, typically 5% position across most all, if not, almost all client accounts.
So if you look at what's happened to gold and silver, they are performing better than tech stocks. If you look at what's happening on a corollary to some of the blockchain technologies and cryptocurrencies and Bitcoin, they're also performing very well. I would speculate that the market is sniffing out this dichotomy in the economy. So higher profitability, weaker labor, which then leads to financial repression. We have way too much debt in the system, and you've all heard us talk about that until we're blue in the face. So we're not going to talk about that today, but we're going to run it hot. So never met a real estate guy that didn't think the right interest rate was zero. If that interest rate sensitive person has their say, interest rates are going to go lower. So that's good for real estate. That's good for some of the real estate REITs that we own. Gold is sniffing that out. Gold is on the rise. Silver, the same thing. Platinum, the same thing. So if we run it hot because we have way too much debt in the system and employment is weak, where does that leave us? And I mean, this is the conundrum we're dealing with, which is rising alternative currency prices at the same, and financial repression, effectively trying to devalue dollars, not just dollars. Europe's got the same issue, Japan's got the same issue, China's got the same issue. There's too much debt in the entire system everywhere. They want to and need to embrace inflation. It's a feature, not a bug. Well, another lively one.
My gosh, all right. I can't imagine what we'll be talking about next time. With that, we'll sign off. And as always, we're available for questions as you have them. And wishing you a great kickoff to your fall season.